Welcome to Chapter 7, Portfolio Management of Bond Funds. Fixed income sounds calm, contractual, and almost polite. The actual portfolio is a moving system of interest rates, yield curves, credit spreads, optionality, liquidity, cash flows, derivatives, and investor redemptions. A bond can make every payment exactly as promised and still produce a painful mark-to-market loss. A fund can own high-quality securities and still struggle if duration is too long or liquidity disappears when shareholders want cash. In this chapter, we will decompose bond returns, use duration and convexity, interpret curve decisions, connect company cash flow to default and recovery, examine mortgage prepayment risk, and study the implementation system around trading and derivatives. We will also revisit March 2020 and the 2022 rate reset, because bond markets have recently provided very expensive teaching materials. The central idea is simple. Yield is never just income. It is compensation for a particular collection of risks. Bond management begins by identifying exactly which risks the investor is being paid to own. The 2022 rate shock is the fastest way to retire the misconception that fixed income means fixed value. During that year, the Federal Reserve raised its policy rate target range by 425 basis points. That rapid reset repriced bonds across maturities. Coupon income kept arriving, but for many portfolios, it was overwhelmed by the price effect of higher yields. The first order rule is negative duration times the change in yield. Longer duration generally means a larger price movement for the same rate change. Credit is the second major engine. Even when treasury yields are stable, spreads can widen as investors demand more compensation for default, downgrade, liquidity, or uncertainty. Then there is the third dimension, liquidity. A model may assign a reasonable value while the price available for a meaningful trade is much worse. The manager must separate rate exposure, spread exposure, and stress liquidation risk. Fixed income is one of finance's more optimistic product names. The coupon may be fixed. The price is free to improvise. This chapter develops 4 practical skills. First, decompose. You should be able to explain bond fund return through coupon income, carry, roll down, rate changes, spread changes, optionality, defaults, recovery, trading cost, and cash flows. Second measure. You should know when to use modified duration, effective duration, spread duration, convexity, yield measures, and scenario analysis. Third, construct. You should be able to connect curve positioning, sector allocation, credit research, security selection, liquidity, and derivative use inside one coherent portfolio. Finally, evaluate. You should decide whether an attractive looking yield actually compensates for credit loss, liquidity, leverage, refinancing, and tail risk. Some objectives require calculation, but the harder work is interpretation. A 6-year duration estimate is useful only if we understand what rate move it describes and whether cash flows can change. A high spread is useful only if expected loss and liquidity do not consume it. The goal is not to memorize every bond term. It is to explain the loss mechanism before the market demonstrates it for us. 4 connected systems organize the chapter. First are the cash flows, coupon, principal, amortization, prepayment, default, and recovery. Every valuation begins with what may be paid, when it may be paid, and what can interrupt the schedule. Second is the rate system, duration, convexity, curve shape, role, and the transmission of monetary policy through discount rates. Third is the credit system, issuer fundamentals, spreads, capital structure, covenants, collateral, and recovery. Finally, there is the implementation system, dealer markets, liquidity, derivatives, leverage, investor flows, collateral, and stress management. These systems interact. A mortgage bond's duration changes when borrowers refinance. A high-yield bond's liquidity can deteriorate as the issuer's credit weakens. A derivative hedge can reduce rate exposure while creating collateral needs. The sequence matters because a bond portfolio is not one forecast. It is several linked decisions that can offset one another or fail at the same time. The goal is a usable mental model, not a filing cabinet full of definitions. Yield is a starting point, not the realized return. Coupon and carry provide contractual income while the position is held. Roll down captures the price effect as a bond ages along a non-flat yield curve. A bond can appreciate simply because it moves toward a lower yielding point on the curve, assuming the curve itself does not change. Rate movement affects price through duration and convexity. Spread movement reflects changing compensation for credit, liquidity, options, and market technicals. Default and recovery determine what happens when the promised cash flow fails. Trading and fund flows add spreads, market impact, financing cost, cash drag, and sometimes forced selling. These engines can pull in opposite directions. A bond may earn a healthy coupon while its spread widens. A portfolio may benefit from falling treasury yields, while mortgage prepayments return principal at unattractive reinvestment rates. The highest yielding fund is not automatically the best income fund. Sometimes the extra yield is opportunity. Sometimes it is fair compensation. Sometimes it is the market leaving a warning note on the windshield. Duration gives the first order estimate of how a bond or portfolio price responds to a small change in yield. The approximation is negative duration multiplied by the change in yield. A portfolio with a duration of 6 years facing a 1 percentage point parallel increase has an estimated price decline of about 6% before coupon, income, and convexity. Modified duration is appropriate when cash flows are fixed and the yield move is small. Effective duration is more useful when embedded options can change the cash flows, as with mortgages or callable bonds. Spread duration measures sensitivity to a change in credit or option-adjusted spread rather than the treasury curve. Convexity improves the estimate for larger moves by capturing curvature in the price-yield relationship. These are approximations, not prophecies. Curves rarely move in perfectly parallel fashion. Spreads can change at the same time, and options can alter duration exactly when the manager needs the old estimate most. Duration is a risk measure. It is not a maturity label wearing a more sophisticated tie. The yield curve creates 3 separate decisions. Level asks how much overall duration the fund should hold relative to its benchmark or liability. Slope asks whether exposure should favor short, intermediate, or long maturities as the curve steepens or flattens. Curvature asks whether selected maturity points are unusually rich or cheap relative to their neighbors. Carry and roll are related but different. Carry is the income earned from holding the position. Roll down is the price effect as the bond moves along the curve through time. Then there is path. Reinvestment and realized return depend on the sequence of rate changes, not just the final yield. A manager can be correct about where rates end and still be wrong about the trade because the path created losses, redemptions, or poor reinvestment opportunities along the way. Yield curve language can sound abstract until a fund makes a large bet on one part of the curve. Then level, slope, and curvature become 3 different ways to explain why the monthly statement looks nothing like the investor expected. Credit research asks a different question from equity research. The company does not need to become extraordinary. It needs to meet its obligations, especially under stress. And the bond spread must compensate for the risk that it will not. Begin with the business. Industry structure, cyclicality, competitive position, and operating leverage, and then map the balance sheet, including debt, maturity walls, secured claims, liquidity, and covenant flexibility, stress cash flow, interest coverage, refinancing needs, and working capital. Next, study the claim itself. Seniority collateral, guarantees, covenants, and embedded options determine where the bond sits in the capital structure. Recovery analysis estimates enterprise value in distress and applies the waterfall among creditors. Finally, compare the spread with expected loss, liquidity, downgrade risk, and alternatives. A company can be a strong brand and a poor credit at the wrong leverage. It can also be an unglamorous business and an excellent bond if the balance sheet is sound and the price is right. Bondholders do not need a beautiful story. They need to get paid. Investment grade and high yield portfolios can lose money for very different reasons. Investment grade funds often carry more treasury rate duration. Default probability is lower, but long maturities can still create large mark-to-market losses when yields rise. Downgrades matter, and corporate, government, agency, and securitized sectors do not behave identically. High yield funds usually have shorter duration, but that can create false comfort. Their returns are more sensitive to credit spreads, defaults, recovery values, economic cycles, and liquidity. In a recession, high yield bonds can behave more like equities because both are exposed to deteriorating business conditions and risk appetite. A shorter duration high yield fund may therefore lose more than a longer duration investment grade fund during a severe credit event. The label tells us something about credit quality, but not enough about total portfolio risk. Compare yield with expected loss, volatility, liquidity, structure, and correlation. Short duration is not the same thing as low risk. It only tells us that one particular risk has a shorter fuse. Securitized bonds add a complication that traditional bullet bonds do not have. The borrower can change the timing of the cash flows. In mortgages, falling rates often accelerate refinancing. Investors receive principal back just when reinvestment yields are lower. When rates rise, B called refinancing slows, and the bond's effective duration can extend. The investor is left with the lower coupon for longer, precisely when higher market yields are available. The homeowner owns the option and tends to exercise it when it is least convenient for the bondholder. Tranching allocates cash flows and losses among different claims, but seniority does not eliminate model risk. Collateral quality, underwriting, geography, borrower characteristics, and seasoning all affect performance. Prepayment, default, recovery, and correlation assumptions can also fail when the market enters a new regime. Option-adjusted spread attempts to separate compensation from embedded options, but the result depends on the model. In securitized credit, the cash flow schedule is not merely estimated. It is negotiated continuously by thousands of borrowers who have never read the portfolio manager's forecast. Bond liquidity is fragmented, episodic, and specific to the issue. Many bonds trade over the counter through dealers rather than in one centralized order book. A single issuer may have dozens of maturities, coupons, covenants, and outstanding sizes. So liquidity is divided across many securities. Dealer willingness to commit balance sheet changes with volatility, regulation, funding cost, and risk appetite. Trace has improved post-trade transparency, but pre-trade depth is still uneven. A screen price may describe a small recent trade or an evaluated estimate. It may not describe what the fund can sell today in institutional size. This difference becomes critical when redemptions arrive during stress. The portfolio manager should distinguish assets that are liquid in ordinary markets from assets that can actually be sold at a reasonable concession during a correlated industry outflow. Liquidity is not a permanent property printed on the bond certificate. It is a relationship among size, time, market conditions, and price. A quote is information. Executable size is the answer. Derivatives can improve portfolio efficiency, but they can also hide leverage and nonlinear risk if the control framework focuses only on the instrument label. Futures and swaps can adjust duration quickly without disturbing a large cash bond portfolio. Credit derivatives can hedge or add spread exposure. Currency contracts can manage foreign exchange risk. Derivatives can also equitize cash, handle inflows, and express curve or relative value views. The control questions are more important than the product name. What is the total derivatives exposure and value at risk? How will margin and collateral be funded? What happens when a hedge and the underlying position stop moving together? Are counterparties diversified and is netting legally enforceable? Can the position be unwound in a stressed market? Rule 18F4 formalizes derivatives, risk management, leverage limits, testing, and board oversight for many registered funds. The right conclusion is not that derivatives are dangerous or safe. The instrument is a tool. The economic exposure, financing path, and control process determine whether the tool is a scalpel or a chainsaw. Two recent stress episodes exposed different bond fund vulnerabilities. In March 2020, investors rushed for cash and even normally deep markets became disorderly. Corporate and municipal bond funds faced roughly $255 billion of monthly outflows, while dealer capacity and market depth were under pressure. The policy response helped stabilize trading and reduce forced sale pressure. In 2022, the dominant problem was different. The Federal Reserve raised its target range by 425 basis points, and duration losses hit many high-quality portfolios, even though default risk remained low. From 2023 through 2026, higher starting yields improved the income available to investors, but refinancing, curve, credit, and liquidity risks did not disappear. These episodes show why the word safe is incomplete. A treasury bond can be safe from default and still lose through duration or inflation. A short duration credit fund can reduce rate sensitivity and still lose through spread widening or liquidity. Safety depends on the loss mechanism. Finance becomes much clearer once we force the adjective to finish its sentence. March 2020 is a useful case in the price of immediate liquidity. Open-end bond funds promised daily redemption, while many underlying bonds could be sold only at large concessions. Redemptions were contractual obligations. Market depth was state-dependent. That mismatch forced managers to decide which assets to sell, how much cash to hold, and how to avoid shifting excessive cost to remaining shareholders. NAV production also became harder because model and matrix prices could lag actual executable levels when trading was sparse. Bond ETFs sometimes traded at visible discounts to estimated NAV. Those discounts looked alarming, but they also provided real-time transaction prices when the underlying cash market was less transparent. In other words, the ETF could be signaling where bonds were actually clearing rather than simply malfunctioning. The policy lesson is broader than 1 month. Liquidity planning, stress testing, cash management, and anti-dilution tools must consider correlated industry flows, not just one fund's normal redemption history. In March 2020, liquidity became less a noun than a question. At what price and what size and for whom? A disciplined bond review begins by naming the risk that produces the return. First, what is the source of yield? Separate the risk-free rate, curve position, credit spread, liquidity premium, option premium, and leverage. Second, what is the duration exposure to parallel moves, curve twists, and spread changes? Third, what default, downgrade, and recovery assumptions are embedded in the portfolio? Fourth, what can actually be sold under stress, in what size, and at what concession. Fifth, how do prepayments, calls, puts, and derivatives change the cash flows? Finally, what do financing, collateral, trading cost, cash balances, and investor flows contribute to the result? This framework prevents the manager from presenting one attractive yield as though it appeared from nowhere. Every additional basis point has a source. Sometimes it comes from skillful security selection or a well-compensated risk. Sometimes it comes from a hidden concentration, an optimistic model, or a liquidity assumption that has not met a bad market yet. The portfolio should be explainable as compensated risks, not marketed as a yield target with the footnotes removed. Now apply the framework to two income funds. Fund A yields 5.1%, has a duration of 6.5 years, and holds mostly investment-grade credit. Fund B yields 6.3%, has a duration of 3.2 years, and owns lower quality credit, meaningful bank loans, and less liquid securitized holdings. The investor may need 20% of the allocation within 1 year and is highly loss averse. Start by decomposing the 1.2% yield difference. Fund B is not simply more generous. It is likely charging the investor for additional credit, structure, and liquidity risk. Next, run scenarios. A 1 percentage point rate rise creates a first-order decline of roughly 6.5% for Fund A before income and convexity. Fund B has less rate sensitivity, but a material spread widening could produce a larger credit loss and poorer liquidity. Then consider the near-term cash need. That requirement may justify a separate short duration or cash allocation rather than forcing either fund to do two incompatible jobs. Pause the video and make a recommendation. You may select Fund A, Fund B, a blend, or reject the comparison. Defend the job, the loss mechanism, and the liquidity plan, not just the headline yield. Pause the video and answer 4 questions before continuing. First, what does duration approximate? Second, why can a high-yield bond fund behave like equity? Third, what is extension risk? Fourth, what is the strongest liquidity question? Resume when you are ready. The answer to question 1 is price sensitivity to a yield change. Duration does not measure default probability or the coupon by itself. The answer to question 2 is that credit spreads and defaults are sensitive to economic conditions. High yield bonds can therefore sell off alongside equities in a recession or risk-off event. The answer to question 3 is that effective maturity can lengthen when prepayments slow, often after rates rise. The answer to question 4 is what size can be executed under stress and at what concession. Yesterday's model price is useful, but it does not pay a redemption. The correct letters are B, B, A, and B. That is still enough. B to look like the quiz was assembled after a very long grading session. But the third answer matters. Extension risk is the first option. The reasoning matters more than the letter. Carry forward 6 ideas. First, yield is a bundle. Income compensates for rate, credit, liquidity, option, leverage, and other risks. Second, duration is first order. It translates a yield change into an approximate price change, but convexity, curve shape, and changing cash flows matter. Third, credit requires downside work. Default probability, capital structure, covenants, and recovery deserve as much attention as the base forecast. Fourth, liquidity is state dependent. Normal trading volume and model prices can fail when many investors seek cash at the same time. Fifth, derivatives change exposure efficiently, but they also introduce collateral, basis, leverage, counterparty, and governance questions. Sixth, the loss mechanism matters. A bond can be high quality, and still lose through duration, inflation, liquidity, or reinvestment without ever defaulting. Yield is a number. The risk story is the footnote that eventually sends the bill. The next chapter applies these ideas to money market funds, where the entire product is designed around stability, liquidity, and a very specific regulatory architecture. This final slide is the source register for Chapter 7. Posen and Hamacher provide the conceptual spine. Federal Reserve materials support the rate history and financial stability context. Securities and Exchange Commission rules support the derivatives and liquidity risk management discussion. Investment Company Institute research provides the March 2020 fund flow analysis and current industry context, while FINRA offers investor-facing bond resources. There is no need to read the web addresses aloud. The important habit is to distinguish primary rules, official statistics, and market data from commentary or product marketing. These sources should be revisited whenever the course is refreshed, because market structure, regulation, fund assets, and product practices change. The discipline remains durable. Decompose the yield, measure rate and spread sensitivity, examine downside and recovery, test liquidity, understand optionality, and account for implementation. Chapter 8 turns to money market funds, which try to make a portfolio of short-term securities feel like cash. As usual in finance, the simpler the user experience appears, the more machinery is working behind the curtain.